In the waning days of 2025, as the world grapples with the aftershocks of escalating trade tensions and monetary shifts, a series of events has converged to expose the fragility of the global economic order. French President Emmanuel Macron's stark warning to China during his state visit in early December, that Europe's patience with Beijing's surging exports is wearing thin, has ignited a diplomatic firestorm. Meanwhile, across the Pacific, Japan's decision to hike interest rates has sent ripples through financial markets, raising fears of a potential unraveling in the U.S. bond market. These developments are not isolated incidents but interconnected threads in a larger tapestry of economic interdependence and rivalry. They underscore a profound truth: the mechanisms that once propelled global prosperity now threaten to undermine it. To understand how we arrived at this precarious juncture, we must delve into the foundations of China's export-driven powerhouse, the diminishing influence of Western nations in shaping Beijing's policies, and the unintended consequences of Japan's monetary pivot on America's vast debt apparatus. Let us begin by examining the roots of China's economic model, a system that has transformed the nation from a largely agrarian society into the world's manufacturing behemoth. In 1978, under the leadership of Deng Xiaoping, China embarked on a path of reform and opening up, marking a departure from the centrally planned economy of the Mao era. This shift emphasized industrialization, foreign investment, and integration into global trade networks. At its core was an export-led growth strategy, where the production of goods for overseas markets became the engine of national development. To appreciate this, consider that exports involve selling products to other countries, generating revenue that can be reinvested in domestic infrastructure, technology, and workforce training. For China, this approach was particularly effective given its abundant labor force and low production costs at the time. By the early 1990s, China's exports were growing at double-digit rates annually, fueled by policies such as maintaining an undervalued currency, the renminbi, which made Chinese goods cheaper on the international stage. An undervalued currency means that when converted to dollars or euros, Chinese products appear more affordable to foreign buyers, giving them a competitive edge over goods from higher-cost economies. Joining the World Trade Organization in 2001 accelerated this momentum, granting China access to global markets on more favorable terms and encouraging multinational corporations to establish factories there. This led to a surge in foreign direct investment, where companies from the United States, Europe, and Japan poured billions into Chinese operations, drawn by the promise of low wages and efficient supply chains. Over the decades, China's export sector expanded across a wide array of industries, from textiles and electronics to automobiles and renewable energy equipment. By 2010, China had surpassed Japan as the world's second-largest economy, and in 2009 it became the largest global exporter. This growth was not without structural challenges. The model relied heavily on state-guided industrial policies, including subsidies for key sectors, which encouraged overcapacity, the production of more goods than the market can absorb domestically. As a result, excess output was directed outward, flooding international markets with affordable products. This overcapacity has been a double-edged sword. It propelled China's GDP growth to average nearly 10% annually from 1978 to the early 2010s, lifting hundreds of millions out of poverty. But it also created imbalances, such as suppressed domestic consumption and reliance on foreign demand. Fast forward to the present day, and these dynamics have intensified. In 2025, China's exports reached record highs, driven by a post-pandemic recovery in global demand and Beijing's continued emphasis on manufacturing dominance. However, this success has come at a cost to trading partners. The European Union in particular has seen its trade deficit with China balloon. To put this in perspective, a trade deficit occurs when a country imports more goods from another than it exports, leading to a net outflow of capital. For the EU, this deficit swelled to nearly $143 billion in the first half of 2025 alone, marking a record for any six-month period. France, as one of Europe's largest economies, has felt this acutely, with its own bilateral deficit approaching €47 billion in 2024. It is against this backdrop that President Macron issued his pointed critique during his December 2025 visit to Beijing. In an interview with the French newspaper Les Echos, Macron did not mince words. He described China's trade surplus as unsustainable, arguing that Beijing was essentially killing their own clients by exporting vast quantities while importing TTLE in return. This surplus, he explained, arises when exports far exceed imports, allowing China to accumulate foreign reserves but straining the economies of its trading partners. Macron highlighted how Chinese goods were inundating European markets, undercutting local industries in sectors like electric vehicles, solar panels, and steel. He warned that if China did not take steps to rebalance, perhaps by increasing imports from Europe or investing more directly in the region, the EU would have no choice but to impose tariffs, following the example set by the United States. Tariffs, for those unfamiliar, are taxes levied on imported goods, designed to make them more expensive and thus protect domestic producers. The EU has already taken tentative steps in this direction, such as imposing duties on Chinese electric vehicles earlier in the year, prompting retaliatory measures from Beijing, including price requirements on French cognac. Macron's threat was not idle rhetoric. It reflected a growing consensus in Brussels that Europe's industrial model is under existential threat. He portrayed Europe as caught in a vice between U.S. protectionism under President Trump and China's aggressive export push, calling it a matter of life or death for European industry. This language underscores the analytical view that China's strategy is not merely economic but strategic, aimed at securing global influence through manufacturing supremacy. Yet as Macron's warnings reverberate, a sobering reality emerges. The West possesses remarkably little leverage to compel China to alter its course. Leverage in international relations refers to the ability of one party to influence another's behavior through incentives or threats. In the case of China, several factors have eroded Western sway. First, China's economy has grown so large and self-sufficient that it can withstand external pressures that might cripple smaller nations. With a population exceeding 1.4 billion and vast foreign reserves over $3 trillion, Beijing can absorb shocks from tariffs or sanctions. A prime example is China's control over rare earth minerals, essential components in everything from smartphones to military hardware. Rare earths are a group of 17 elements used in high-tech applications, and China dominates global production, accounting for about 80% of supply. In response to U.S. restrictions on technology exports, Beijing has weaponized this dominance through calibrated export controls. In December 2024, it banned exports of several rare earth elements to the U.S., followed by stricter controls on 7 more in April 2025 after tariff threats, and an additional 5 in October. These moves were not blanket bans but targeted retaliations, designed to inflict pain without escalating to full confrontation. Similarly, in May 2025, China halted purchases of U.S. soybeans, its largest import from America by value, further demonstrating its ability to pivot away from Western suppliers. This strategy is part of what analysts describe as China's long economic war, a deliberate effort to build leverage for prolonged rivalry with the West. By diversifying export markets through initiatives like the Belt and Road Initiative, which finances infrastructure in developing countries to create new outlets for Chinese goods, Beijing reduces its dependence on any single partner. Moreover, domestic political imperatives drive this autonomy. Chinese leaders view concessions as echoes of historical humiliations, such as the unequal treaties of the 19th century. The U.S., despite its alliances and the dollar's dominance, faces constraints from internal divisions and fiscal strains, limiting its capacity to match China's scale in areas like green energy or artificial intelligence. Europe's position is even more precarious. While the EU has attempted to de-risk, reducing reliance on Chinese supply chains, progress has been slow. Dependencies persist in critical sectors from pharmaceuticals to renewable energy components. Macron's calls for cooperation, such as dismantling restrictions on European semiconductor exports in exchange for eased rare earth access, highlight this bind. The West needs China more than it admits. As one expert noted, myths about China's predatory economics often overlook Western policy failures, such as underinvestment in domestic manufacturing, which have amplified these imbalances. Turning our attention eastward, another pivotal development in December 2025 has amplified these tensions: Japan's interest rate hike and its potential to trigger turmoil in the U.S. bond market. To grasp this, we must first understand the role of bonds in global finance. Bonds are debt instruments issued by governments or corporations to raise funds. Buyers lend money in exchange for periodic interest payments and the return of principal at maturity. US Treasury bonds, in particular, are considered the world's safest assets, backed by the full faith and credit of the American government. Foreign investors, including central banks, hold trillions in these securities as a store of value and a hedge against uncertainty. Japan stands as the largest foreign holder of US Treasuries, with holdings reaching approximately $1.189 trillion as of September 2025, an increase from previous years, reflecting Tokyo's strategy to manage its vast foreign reserves. This accumulation stems from Japan's export-oriented economy and interventions to stabilize the yen. For decades, the Bank of Japan maintained ultra-low interest rates, often near zero or negative, to combat deflation, a persistent decline in prices that stifles growth. This policy encouraged the yen carry trade, where investors borrow yen cheaply and invest in higher-yielding assets abroad such as US bonds or equities. On December 19, 2025, the Bank of Japan pulled the trigger on a significant policy shift, raising its benchmark rate by 25 basis points to 0.75%, the highest in 3 decades. Governor Kazuo Yuta justified this as a response to a recovering economy, tight labor markets, and moderate inflation expectations around 3%, a far cry from the deflationary stagnation of the past. Immediate market reactions were telling. The yen strengthened against the dollar, Japanese stocks showed mixed responses, and emerging market currencies weakened as carry trades began to unwind. The unwind of the yen carry trade is a critical mechanism here. As Japanese rates rise, the yield differential with the U.S. narrows. The spread between one-year Japanese and U.S. Treasury yields has halved from its 2023 peak of 5.5% to about 2.68%. This makes borrowing yen less profitable, prompting investors to sell U.S. assets to repay loans. Estimates suggest up to $500 billion in carry positions could be affected, leading to capital outflows from American markets. Japan's 10-year government bond yield surged to 2.1%, making domestic bonds more attractive and potentially accelerating a sell-off of U.S. Treasuries. This dynamic evokes the butterfly effect, where a small change like a rate hike in Tokyo cascades into larger disruptions. Analysts project that sustained unwinding could pressure U.S. bond prices downward, pushing yields higher. Higher yields mean increased borrowing costs for the U.S. government, corporations, and consumers, potentially slowing economic growth. While no full-scale crash has materialized yet, warning signs abound. Volatility in the VIX index rose, and options markets priced in higher uncertainty for early 2026. If Japan accelerates its treasury reductions, though unlikely en masse due to the nuclear option risks, it could exacerbate this. Step by step, let us trace the sequence of events in 2025 that led to this convergence. The year began with U.S. tariff threats under President Trump, prompting China's rare earth restrictions in April. By mid-year, EU exports to China stagnated amid overcapacity floods, setting the stage for Macron's December visit. Concurrently, Japan's economy showed signs of normalization. Core inflation stabilized, wages rose modestly, and the Bank of Japan hinted at tightening. The December 19 rate hike, following hawkish remarks from Governor Yuta, triggered immediate global ripples. Bitcoin dropped 2.8%, Ethereum 4%, and emerging markets like Mexico and Brazil saw currency depreciations. Behind these visible events lie hidden factors, often overlooked in mainstream discourse. Geopolitically, China's export push is intertwined with its quest for technological self-reliance, accelerated by U.S. chip bans. Rare earth controls are not just economic but strategic, securing advantages in clean energy and defense. For the West, internal fractures, such as U.S. political polarization and Europe's energy dependencies post-Ukraine, dilute unified responses. Japan's hike, meanwhile, reflects domestic imperatives, escaping deflation traps while navigating U.S. alliance pressures. Currency manipulations like Japan's past interventions to weaken the yen add layers. A stronger yen now hurts exporters like Toyota but aids importers. The global implications of these developments are profound and multifaceted. A U.S. bond crash, even partial, could elevate borrowing costs worldwide, as Treasury yields influence everything from mortgage rates to corporate debt. Historical precedents like the 1994 bond crisis that erased $1.5 trillion in global value remind us of the contagion risks. Higher rates discouraged refinancing, slowed growth, and sparked disputes. In today's context, emerging markets already strained by dollar strength face capital flight. Currencies like the Mexican peso and Turkish lira have weakened. Stock markets, interconnected with bonds, could see amplified declines, as seen in the S&P 500's vulnerability to outflows. More broadly, these events challenge the U.S. dollar's hegemony. If treasuries lose their safe haven allure questioned amid tariff-induced volatility, investors might diversify into euros, yen, or even renminbi, reshaping global finance. For Europe, persistent deficits could erode industrial bases, fostering deindustrialization and job losses. China, while resilient, risks retaliatory spirals that dampen its growth, potentially exacerbating domestic issues like property crises. Japan, by normalizing policy, might invigorate its economy but at the cost of global stability. In conclusion, as we reflect on these interconnected crises, France's rebuke of China's exports, the West's eroded leverage, and Japan's inadvertent spark to U.S. bond woes, we confront a world in transition. The export-led model that fueled China's ascent now strains the very partnerships it depends on, while monetary divergences reveal the limits of globalization's promises. These are not mere economic footnotes but harbingers of a multipolar order, where power diffuses and vulnerabilities multiply. Policymakers must navigate with caution. Tariffs may protect in the short term but invite escalation. Rate hikes stabilize domestically but unsettle internationally. For ordinary citizens, from French factory workers to American retirees, the stakes are tangible: higher costs, uncertain jobs, volatile savings. Yet amid the turbulence, opportunities emerge for diversified supply chains, renewed innovation, and collaborative reforms. The path forward demands not confrontation but measured dialogue, lest the fragile bonds of global interdependence fray beyond repair. As 2025 draws to a close, the lessons are clear. In an era of economic warfare and butterfly effects, no nation stands alone. As these interconnected economic forces gather momentum in the closing weeks of 2025, the world finds itself at a crossroads where long-standing imbalances are being forced into the open. French President Emmanuel Macron's direct confrontation with Chinese leaders during his state visit earlier this month, coupled with his subsequent warnings of impending European tariffs, has laid bare the strains in one of the most vital trade relationships on the planet. At the same time, the Bank of Japan's decisive interest rate increase on December 19, raising its benchmark to 0.75%, the highest in 3 decades, has introduced new uncertainties into global bond markets, particularly for the United States, where fears of capital repatriation and higher yields linger. These events, occurring in rapid succession, reveal not only the limits of Western influence over China's export strategy, but also the delicate linkages that bind monetary policies across continents. To fully appreciate the depth of this moment, we must explore the less visible undercurrents: the strategic use of critical minerals as bargaining chips, the persistence of the yen-carry trade despite policy shifts, and the broader geopolitical calculations that shape these economic decisions. One of the most understated yet pivotal elements in this narrative is China's calculated deployment of export controls on rare earth elements and related technologies. Rare earths, as previously noted, are a suite of 17 metallic elements indispensable for advanced manufacturing, including permanent magnets used in electric motors, wind turbines, semiconductors, and defense systems. China's dominance in this arena, processing over 90% of global supply, has long provided it with asymmetric leverage. In 2025, Beijing has escalated this advantage through a series of targeted restrictions that go beyond mere quotas, extending to technologies and even extraterritorial applications. The sequence began earlier in the year with controls on 7 rare earth elements in April, introduced in response to escalating U.S. tariffs. This was followed by broader measures in October when the Ministry of Commerce announced controls on additional elements: holmium, erbium, thulium, europium, and ytterbium, along with refining technologies and permanent magnets. These rules required licenses not only for direct exports from China, but starting December 1, for foreign-produced items incorporating Chinese source materials above minimal thresholds or manufactured using Chinese technologies. This extraterritorial reach mirrors tactics employed by other nations in technology controls, but applies them to foundational materials, effectively compelling global companies to seek Chinese approval for downstream products. Although a partial pause was negotiated in late October, delaying some of the most expansive measures for a year following high-level talks, the core restrictions remain intact. These include heightened scrutiny for end users in semiconductors and defense, with applications tied to military purposes facing presumptive denial. For Europe, this has compounded vulnerabilities in automotive and renewable energy sectors, where rare earth magnets are critical. Macron explicitly raised these concerns during his Beijing meetings, proposing a mutual de-escalation, Europe easing limits on semiconductor equipment exports in exchange for China relaxing rare earth curbs. Yet progress has been limited, underscoring how these controls serve dual purposes, protecting domestic industries while signaling resolve in broader rivalries. This mineral strategy is often overshadowed by headline trade figures, but represents a hidden factor amplifying Western constraints. Unlike tariffs, which are overt and reciprocal, resource controls operate quietly, disrupting supply chains without immediate retaliation options. Diversification efforts, such as new mining projects in Australia or recycling initiatives in the United States, are years from scaling meaningfully. In the interim, dependencies persist, muting the effectiveness of threats like Macron's tariff warnings. Beijing's approach reflects a long-term view by calibrating restrictions, avoiding outright bans but imposing delays and conditions. It inflicts calibrated pressure, encouraging concessions without provoking full confrontation. Parallel to these developments, the Bank of Japan's rate hike has prompted intense scrutiny of the yen carry trade's resilience and its implications for U.S. bonds. The carry trade, a strategy of borrowing in low-yield yen to invest in higher-return assets elsewhere, has been a cornerstone of global liquidity for years. With Japanese rates near zero for decades, investors ranging from hedge funds to institutional players accumulated positions funded by yen loans, channeling funds into US Treasuries, equities, and emerging markets. The December 19 hike, while anticipated, narrowed the yield differential further, with Japan's 10-year government bond yield climbing toward 2.1% in subsequent sessions. Initial market reactions included a temporary yen strengthening, but the currency later weakened amid perceptions that the Bank of Japan would proceed gradually. Governor Kazuo Uda's post-decision comments emphasized ongoing accommodation with real rates remaining low, which tempered expectations of aggressive tightening. This nuanced stance has allowed elements of the carry trade to persist, as the cost of yen borrowing, though rising, remains competitive globally. However, hidden risks endure. Estimates of outstanding carry positions vary, but unwinding even a fraction could generate significant outflows from U.S. assets. Japan, holding around $1.19 trillion in U.S. Treasuries as of late 2025, represents the largest foreign creditor. While wholesale dumping is improbable given mutual interests in stability, gradual repatriation to fund domestic opportunities or cover fiscal needs could elevate U.S. yields incrementally. Post-hike, U.S. 10-year Treasury yields edged higher in sympathy with global bond movements, though no acute sell-off materialized. Analysts note that the trade's unwind is likely to be protracted rather than explosive, influenced by Japan's domestic recovery marked by wage growth and inflation nearing 3% and the need to balance exporter competitiveness with currency stability. Less discussed is the interplay with U.S. fiscal dynamics. America's persistent deficits require robust foreign demand for treasuries. As Japanese investors reassess allocations amid rising domestic yields, this demand softens, potentially amplifying borrowing costs at a time when tariff policies risk inflating import prices. The convergence of central bank paths, Japan tightening while others ease, exacerbates this, though the dollar's reserve status provides a buffer. On the trade front, China's export surge continues unabated, with November data showing sharp increases to Europe amid diversions from U.S. markets. This has widened deficits further, prompting Macron's post-visit assertions that without rebalancing, through increased Chinese imports or investments, Europe would resort to duties. Yet consensus within the EU remains elusive, with varying national exposures complicating unified action. These threads converge in their global implications. Escalating trade frictions risk fragmenting supply chains, elevating costs for consumers and industries worldwide. Higher U.S. yields could constrain growth, particularly if compounded by fiscal strains. Emerging markets reliant on dollar funding face renewed currency pressures from carry adjustments. Geopolitically, resource weaponization sets precedents, potentially inspiring similar tactics elsewhere and eroding trust in open markets. In this environment, the global economy confronts a rebalancing act fraught with peril. China's model, resilient yet provocative, sustains growth but invites isolation. Japan's normalization, prudent domestically, exports volatility. The West's diminished leverage highlights the need for internal reforms, bolstering competitiveness, investing in critical technologies, over-reliance on external pressure. As we approach 2026, the path ahead demands prudence, dialogue as Macron adv. OCATS offers the best avenue to de-escalate, fostering mutual investments and technology sharing. Unilateral measures, while tempting, often beget retaliation, deepening divisions. The interconnectedness revealed in these events reminds us that economic policies ripple far beyond borders, affecting livelihoods from Parisian workshops to Tokyo boardrooms and American households. In navigating this transition, foresight and cooperation will determine whether we emerge with a more equitable order or entrenched rivalries. The choices made in the coming months will shape the economic landscape for years to come. As December 2025 progresses, the interplay between these economic forces has intensified, revealing deeper structural vulnerabilities in the international system. President Macron's state visit to China from December 3 to 5, during which he met with President Xi Jinping in Beijing and later in Chengdu, brought trade imbalances to the forefront of diplomatic discourse. In the days following his return, Macron articulated a clear position. China's persistent trade surplus with Europe is untenable, as it effectively undermines the purchasing power of its own customers by limiting imports. He emphasized that without corrective measures, such as increased Chinese imports from Europe or greater direct investment in the region, the European Union would be compelled to implement protective tariffs in the coming months. This stance reflects not only France's bilateral concerns, where the goods trade deficit approached €47 billion in the prior year, but also the broader European predicament, with China's surplus against the EU reaching nearly $143 billion in the first half of 2025 alone, a record figure that highlights the redirection of Chinese exports away from tariff-burdened U.S. markets toward Europe. Macron's approach during the visit balanced criticism with proposals for cooperation. He advocated for mutual de-escalation, suggesting that Europe could ease restrictions on exports of advanced semiconductor equipment in exchange for China relaxing its controls on rare earth elements. These minerals, vital for industries ranging from electric vehicles to defense technologies, have become a focal point of tension. China's export controls, expanded throughout 2025, include measures from April targeting 7 elements and further escalations in October adding 5 more: holmium, erbium, thulium, europium, and ytterbium, along with technologies for refining and magnet production. Although a partial pause was announced in late October, delaying some extraterritorial applications for a year following US-China talks, the core restrictions persist, requiring licenses for exports and imposing scrutiny on end users, particularly those linked to semiconductors or military applications. This calibrated strategy allows Beijing to maintain pressure while avoiding outright bans, preserving its dominant position in processing over 90% of global rare earth supplies. The timing of these developments coincides with the Bank of Japan's policy shift on December 19, when it raised its short-term policy rate by 25 basis points to 0.75%, the highest level in 3 decades. Governor Kazuo Yuta framed this as a continuation of normalization, responding to sustained inflation around 3%, tightening labor markets and broadening wage growth. While the move was widely anticipated, its implications extend far beyond Japan's borders. Higher domestic yields, with the 10-year Japanese government bond approaching multi-decade highs, narrow the interest rate differential with the United States, diminishing the attractiveness of borrowing in yen to fund investments elsewhere. This dynamic revives concerns over the yen carry trade, a long-standing practice where investors leverage low-cost yen funding to purchase higher-yielding assets abroad, including substantial holdings of US Treasuries. Japan remains one of the largest foreign holders of US debt, though its position has fluctuated amid earlier adjustments. The potential for gradual repatriation of capital, as domestic opportunities become more competitive, could contribute to upward pressure on U.S. yields at a moment when American fiscal demands remain elevated. Although no abrupt sell-off has occurred, the narrowing yield spread risks a protracted unwind, prompting investors to reassess positions and potentially amplifying volatility in global bond markets. Emerging economies already navigating currency pressures could face additional strains from reduced capital inflows. Step by step, the events of late 2025 illustrate a chain of reactions rooted in earlier policy choices. U.S. tariff escalations diverted Chinese exports toward Europe, exacerbating deficits and prompting Macron's warnings. Concurrently, China's resource controls responded to technology restrictions, entrenching dependencies. Japan's rate hike, meanwhile, addresses domestic recovery but RTS subtle disruptions through financial channels. Hidden beneath these headlines are enduring factors: the shift toward multipolar economic influence where no single nation dictates terms unilaterally, the persistence of supply chain concentrations despite de-risking efforts, and the challenge of coordinating policies in an era of fragmented globalization. The global implications are extensive. Trade frictions threaten to elevate costs across supply chains, from consumer goods to advanced technologies, potentially dampening growth in an environment already marked by uncertainty. Higher borrowing costs, if sustained, could constrain investment and consumption worldwide. For developing nations, reliance on export-led models becomes riskier amid protectionist trends. Yet, these pressures also highlight pathways for adaptation: accelerated diversification of critical mineral sources, renewed focus on domestic innovation, and incentives for balanced investment flows. In reflecting on this confluence, Europe's confrontation with China's export dominance, the constraints on Western influence, and Japan's monetary pivot reverberating through U.S. bonds, we discern a pivotal moment in economic history. The post-war framework of open markets and interdependent growth, while yielding unprecedented prosperity, has also fostered imbalances that now demand recalibration. Confrontational measures may offer short-term relief but risk entrenching divisions, whereas sustained dialogue could yield mutual accommodations, such as shared investments and technology access. As the year ends, the imperative is clear. Nations must prioritize resilience and cooperation to mitigate disruptions, ensuring that economic policies serve broader stability rather than narrow rivalries. The decisions taken in the months ahead will not only shape recovery trajectories but define the contours of global interdependence for the decade to come. In this interconnected landscape, the actions of one economy inevitably echo across others, reminding us that true leverage lies in collective foresight rather than isolated strength.